Let's head on over to LaSalle Street, where we have the founder and chief strategist of Path Trading Partners, Mr. Bob Iaccino, standing by to talk financial markets, currencies, and treasuries. Bob, welcome to the show. Good to have you back. I want to talk treasuries after the break, but first currency markets, because it's been a busy week, especially for the British pound. They saw some better than expected inflation data. That was yesterday, but most of the lift seems to be coming from some optimism related to Brexit talks. Can you fill us in terms of the latest and give us your thoughts on the move up that we've seen off those mid-August lows?
Yeah, sure, Ben. Thanks for having me. I think you have to consider the British pound to be one of the better long trades. For quite a while now, we did not have a breakthrough in the Brexit talks that were actually initiated by the Eurozone. And I think that's the really interesting twist to the current round of let's try and break this down kind of Brexit talks, because we've had a few of these. Most of them have been initiated by Theresa May and the UK. And I'm not sure if the EU kind of took their threat of saying, screw it, we'll just do a hard Brexit and that's that. We'll have another referendum, which I think is lower probability. But I think that, again, the EU initiating would be similar to, if you look at the U.S.-China trade wars, China initiating. It would be that kind of a move where you're starting to see cracks in the armor. Now, again, I think that the better than expected data we've seen out of the UK can be tempered by a deadlocked Brexit. Just the idea that talks are moving forward kind of makes that British pound probably the best trade against the dollar in the short to medium term.
So, Bob, let's stick with our neighbors across the big pond there. I want to talk a little bit about the U.S. dollar, because in the past we've talked about how the Trump administration is trying to talk it down in months past and the impact that rising dollar has on the U.S. indices. But this applies to foreign markets as well, correct? I mean, we saw the FTSE on the rise as the pound was coming off, but I'm wondering if we should expect the opposite now that the pound is starting to firm up some. Should we actually expect to see the FTSE decline? Or will a soft Brexit provide enough optimism to go around, possibly enough to lift both the FTSE and the pound simultaneously?
Yeah, it's interesting. When you're looking strictly on currency markets' effect on global economies, that's the story. If your currency strengthens, you should get a little bit of weakness. But when you're looking at an overall backdrop of positive economic growth, there's really two reasons to buy or sell a currency, right? One is interest rate differential or future interest rate differential. The other is that whole old school thought that when you're buying a currency, it's like buying a share in that country's economy. So I think that's what's going to be the case in the FTSE if we get sort of a crack in the Brexit sort of stalemate. If we actually get that to break open and we get an agreement, I think, again, the FTSE will go higher along with the pound going higher, which has happened in the U.S. We've seen U.S. stocks rally, all three indices, including dragging the Russell as well, when the dollar is rallying for reasons of a strong economy. When it's rallying because of a breakdown in EM, there's a little more weakness. That's a little bit different.
All right, well, definitely something to watch there in terms of the FTSE and here in the U.S. markets associated with the U.S. dollar. But let's rein it in a little bit here, Bob. Let's talk about our neighbors to the north and to the south, because with all the latest in terms of tariffs on China, I've lost sight of the NAFTA negotiations. Talk to me, Bob. What's the latest? What have you been hearing? Has there been any progress?
Yeah, and that again is a good currency story, Big Ben. You're looking at a peso and Canadian dollar that had strengthened last week significantly, and that to me was based on sort of background optimism that a deal would get done. Again, today was the push deadline. The prior deadline was 2 Fridays ago. Canada needed to be on board, or Trump was going to move ahead without them. He's getting pressure from his own party and from Congress in general that they're not going to ratify an agreement unless it includes Canada. So this is what I'm hearing in the background, is that has to get done. Now, President Trump does have the option of saying, fine, NAFTA's in place. However, I'm going to add tariffs to Canadian goods in light of national security, which is silly from a perspective of, is that true? Do we have a national security issue with Canada? I think sort of the strength of the marijuana production in Canada is going to be the excuse, but it is an excuse. I mean, make no mistake, it would be an excuse, and it would be sort of retaliatory to Canada not sort of breaking down on some of the things they're insisting upon. The U.S. is seen as having backed down on some of the key negotiating points. I think the negotiations are going to bear fruit, and I think, again, the drive of the peso and the Canadian dollar against the U.S., that's where you're seeing that come from.
So, Bob, ECA data this week, for the most part, well, the last 2 weeks really kind of light. No major reaction from CPI or PPI last week. some housing data this week, but for the most part today, the focus is going to be on the Philly Fed and the jobless coming out in just a couple minutes. Talk to me, what should we be looking for here? We know we got a tight labor market. Is the focus going to be Philly Fed?
It is, and I think you're going to look at employment costs, the employment cost sector of that.
Okay.
You're going to be looking at it, all the major Fed indices now, from the Chicago Fed, Richmond Fed, Philly Fed, even the New York Fed, which has kind of been sort of a lesser gauge over the years. It's been one we've watched a little bit less. You're going to want to watch the employment component of all of those. Today, obviously, the Philly Fed employment component, because we have seen some wage growth, but we have not seen it. We've been waiting for wage growth. Now we got to see if it bleeds into prices. CPI is a little bit of a lagging indicator. We'll look more at PCE deflator, but we have not seen it bleed in. So far, everything's being absorbed.
Yeah, we have the dollar tanking into this number down by 0.75%. I wonder if it's in anticipation of, we're going to get actual numbers here in just a couple minutes. Bob, we got to hop, so stick around though, because I'd like to get your thoughts on the numbers. I'd also like to talk a little bit about the treasury markets, because we saw yields in the TYX and the FVX yesterday in the new 2018 highs, so a lot to discuss there. Traders, when we come back, we'll have more with Bob Iaccino. We're talking treasuries. We'll also be talking here market reaction to the numbers and more. Again, Bob Iaccino, he's the founder and chief strategist here at Trading Partners. Now, we'll be back shortly after this break right here on the TD Ameritrade Network. Welcome back to Futures with Ben Lichtenstein. I'm rejoined by Bob Iaccino. He's the founder and chief strategist at Path Trading Partners. Bob, thanks for sitting tight with us through the break, because I want to get your thoughts on the treasuries, which have created a bit of a stir this week. But first, let's talk a little bit about the numbers, because we just got a jobless release. We know we've got a tight labor market. Anything jumping out at you there? It looks like the number came in 201,000, a little bit below the estimated. They were looking for 210,000. Prior, again, being the 204. Anything stand out there, Bob?
I'm just watching, I'm sure you know what this app is right here. I'm just kind of watching the dollar index get killed.
Yeah, it's coming off.
It stands out to me that the euro is not really moving against the US dollar, yet the index is getting killed, and the US dollar is the euro US dollar is the largest component of that dollar index product. So I'm also looking at this 201 number. Those are really low numbers. If we start coming in with jobless claims numbers consistently below 200,000, I mean, that's like the 1960s, Ben, if it were consistent. Hasn't happened yet. Those are really good numbers. And the interesting part to me is you continue to see longer term yields rise. We saw that a couple of days ago with that huge sell-off that we got in the 30-year bond futures, rising of the yield, of course. And a lot of that had to do with the news that China had bought quite a bit less of U.S. Treasuries than they had in the past. They already talked about not using the yuan as a retaliatory tactic toward the U.S., and that's probably true, and that may be what drove that 30-year bond sale, but we're seeing it across the board. We saw Italian bonds go to almost 7-month highs in yield. That drove the Bund to 3-month highs in yield, about 0.5 basis points now on the Bund, so it's global. So this again tells me somewhere in the pipeline, somebody believes these trade things will get resolved. We saw an announcement yesterday from the Chinese government that they were going to reduce tariffs on select nations to try and keep costs down to their consumers. That to me was read as they are worried about their economy, and maybe they will bend a little bit. If they're raising tariffs on the U.S. but reducing it on other countries, I assume that meant not the U.S., right? To try and keep inflation down to their own populace. These are interesting times. That yield rise and the dollar fall tells me that people believe the yield curve is going to steepen quite a bit. And I mean, that technically means the yield curve is going to steepen, right? So it looks to me like you got to look at bank stocks again. I mean, I know we're a future show here, but you know, that bond trade that's significant to me.
Yeah, we saw the bank stocks get quite the lift yesterday in reaction to the rates on the rise. So I agree, Bob. It's not only futures. We talk about markets that are on the move here, and certainly as rates affect those stocks, you're going to want to stay dialed in on them. But Bob, I'm noticing we're getting a little bit of a lift from the dollar here. You mentioned it's been under pressure here this morning, but it looks like it's coming in reaction to this 730 number. Possibly it's the Philly Fed index. Let's take a look at that number as well, because we just showed jobless, but there were two numbers here, Bob, at 730. Let's take a look here. We had Philly Fed, which came in here this morning. Again, we've got the full screen for you so you can see traders at 22.9. Bob, well above the estimated 19.6 and well above prior 11.9. That's almost double what we saw prior. I imagine this stands out a bit.
It does. This is a strong economic data day. And again, we get volatility in those Fed indexes. You remember, Benny, from being on the floor here, we look at those Philly Fed indexes, but we understood the volatility that you get month to month, especially in the Philly number. Put that together, though, with a strong Chicago Fed, strong New York Fed index, strong Richmond Fed index. If we get those, which those will be coming out in subsequent days, that's a strong sign, and that's going to affect the way the FOMC looks at rates. We already saw 2019 March, we saw the probability of that rate hike start to creep up above 50%. So if we start to price in 2019 rate hikes, this dollar sell-off we're getting will find a floor.
So, Bob, for the last few months, you know, you've been on the show a bunch, and we've talked about this together, that shorter end of the Treasury futures market's leading lower, and consequently, rates on the rise. But until this week, it's been primarily isolated to the 2s and the 5s as the longer end has been reluctant to participate. But that started to shift a little bit this week. I'm wondering if you think that this might have something to do with trade tariffs as well, if they're the straw that broke the camel's back.
Well, tariffs are inflationary at their core. They add cost to the consumer. That's what they do. The unfortunate part of this is that that's not something the Fed can combat. So when you initially see these long-term yields rise, to me it's a belief that the tariff wars, especially between the U.S. and China, trade wars, tariff wars, whatever you want to call it, I don't think it's going to slow trade. So I'm calling it a tariff war right now. That's inflationary, and it's not something the Fed can take away. So you have to start pricing that into your longer-term yield forecast. 10-year and in, I mean, it's a bit of a fulcrum, that 10-year note. But the Fed can't fight it. The Fed could only bring in a period of rising inflation, which the Fed would not be bringing in, the tariffs would, and slower growth, which the Fed would be escorting in. So it's a really interesting dichotomy there where you might see a much steeper yield curve, a weaker dollar, and higher long-term rates if the trade wars extend out.
Bob, let's just bring this all together here real quick. Last question. We were talking currencies before the break. We've been talking treasuries, and we've been talking rates for the most part since. A little bit of economic data mixed in there, but let's bring it together. We've got rates on the rise, but you mentioned again, and we just took a look at the dollar mostly on the decline. Where's the disconnect?
I think the disconnect is in commodity prices. You look at commodity prices. We saw a two-day rally in copper. To be honest, I'm completely unprepared. I don't know where copper is today. But copper will tell you if China's property market's going to recover. If copper starts to rally to the point where, actually I did look at it, that's a bit of a lie. I did see natural gas fall off a little bit, and I saw copper kind of flattening out. But if copper was going to continue to rally, that is an indicator more so of the Chinese economy than the global economy. So that's where you're going to get your hint. Is China doing well regardless of the tariff wars, or are they actually going to start to back off, and is there going to be a crack in the armor there? Copper's what's going to tell you that.
All right, well, we've been keeping a close eye on copper as well, so I guess we're dialed in on the right markets to keep a close eye on here.
You're looking at the right stuff, Benny.
We'll continue to, Bob, and we look forward to having you back to help us do so. Traders, that's Bob Iaccino. He's the founder and chief strategist of Path Trading Partners.